Welcome to today's Zoffy. It's Friday, May 23rd, and we're going to be talking to economist Kevin Birn of IHS MarkIt. Kevin has done many interviews with him over the last 5 or 6 years to better understand the oil sands, both production costs and GHG intensities. He's done the most work, I think, of anybody on those two topics. So welcome to the Zoffy, Kevin.
Thanks, Mark.
Kevin, let's talk about production costs first. And I've been through your data, and the Canadian Energy Research Institute publishes an annual supply cost for the oil sands. And I remember in one of our interviews you said that on average the oil sands companies drove their costs down at least 40% after the 2015-2016 crash. So they were much more competitive. And I think people will be surprised at just what the cost per barrel is to get a barrel of bitumen or heavy crude out of the ground. So can you give us a little overview?
Sure. I think costs are one of the more confusing things for people to understand because there's different ways to skin it. And when companies talk about costs, or analysts like me talk about costs, they tend to just assume everybody knows which costs they're talking about. And when you look at any kind of upstream investment, there's a distinctive difference between the capital cost required to develop an extraction process or drill a well versus the cost to continue to maintain that production. And in the environment we're living in now, that's a huge distinction, to be honest. So in terms of the oil sands, we saw a run up in capital cost almost consistently through early 2000 right to 2014. We track capital cost as an indices, and it was on a 35-degree line upwards. And at that time in 2014, I think there was a general consensus of concern within the industry that the unabated increase in those cost inflation was pricing their product into a place that they weren't going to be able to continue to grow at the same rate. That all changed pretty dramatically in 2015. Necessity is the mother of invention, and the low price environment really forced producers to cut capital, cut capital and operating costs. And so this is where we get into the differences. And in terms of this new projects, you need to consider the upfront capital to develop it. And so that comes down to how efficient is the productivity of human labor, which is a major component of it. What's the price of steel, but also what's in the structure. What do they actually physically have to build? And that's what they went after. Could they build these things leaner? Could they remove steel? Could they build them quicker? On the operating costs, they did the same thing, but it's all fundamentally different. These are the costs that maintain output every single day. In total, we saw on the operating cost reduction somewhere 40 to 50%. That's what that 40 to 50% comes about. So in 2014, I would have told you a thermal operation needed $16 to $18 per barrel to produce on an operating cost basis. Now they're $6, $7 per barrel. Now that isn't all their costs to produce, but I'll stop. We can get into that if you want, Mark.
Yeah, that's really interesting. And there is a difference between the mining and the steam-assisted gravity drainage, the SAGD. Am I correct on that?
They're fundamentally, they have about as much in common as a conventional well and a thermal plant. The only thing they have in common is they both mine or access bitumen as their feedstock.
So what would be the operating cost for a company like Synovus? Because they were in the news last week, and they're a low-cost producer on the SAGD side. So what would cost for a company like Synovus be?
So to make sure we're talking about the same thing, operating costs for them would be, I haven't checked their quarterly, I just assume it's somewhere $7 to $8 US per barrel, maybe less. But I think the but's a big part here. The operating cost isn't the entirety of the costs required to produce a barrel of oil in a thermal extraction plant. They need to acquire diluent. They need to pay for that diluent to move in situ with the bitumen to market. They have to transport, so that's transportation costs. And then if you want to get into it as well, you have to consider when we compare things, what we're comparing against. And so if you compare against inline benchmarks, there's a quality differential as well. So if you take in that operating cost, those diluent costs, including the transportation to market, and you adjust it over to a WTI basis, West Texas Intermediate, so the major North American crude benchmark, you're probably looking at an average operating cost or cash cost to operate. That's what those, if you bucket all those things together, so what I call them is cash cost to operate, somewhere in and around $25 a barrel right now. But that range does span. maybe $24 a barrel, and some of the operations were up to $40 a barrel.
I was looking through Synovus's investor presentation the other day, the one from December of 2019, and they said that their break-even, WTI break-even, is now $40 a barrel. Wasn't that a couple of 3 years ago, I was interviewing Javier China, who's the VP of technology for Synovus, and he indicated at that time that their break-even was 45 to 55. So it looks like Synovus has, even just in a few short years, has done, you know,
I was talking generically, though. I wasn't specific to you. As a rule, I shouldn't talk specifics. I talk generically across the industry. So, but I should also say, in low price environments, there are many things that work to drop that cost temporarily even further. And so those numbers I was telling you, $25 would be the environment we're in the 2020 average. So things like exchange rates, they pay a number of their costs in Canadian dollars while they sell a product in US dollars. That'll help deflate and mute the impact on their balance sheet of this environment. Input costs fall. There are consumers of diluent. The cost of diluent's down. The only thing that hasn't really fallen is natural gas for them, which typically, historically has fallen in these environments. And so there is some deflationary impact on the cost of this environment. So as we come out the other side, I'd expect some of those costs to come up. The other thing that's going on too in operating costs, and you might see discrepancies from what I'm telling you from quarterly statements, as they throttle back their production, as they pull back on their output and hold back what their producing potential is, their cost per unit is going to go up. They have a large fixed cost component associated with their production. And so as they pull back their units, the cost per unit goes up. And so that you might see, what I'm showing you is what it would be if they're operating near their design capacities, which they're not.
Now, one of the points that you've made a number of times to me in our interviews is that when we compare the Alberta oil sands producers to their competitors, we shouldn't be comparing them to like shale producers or light sweet crude oil producers. Their true competitors are really the heavy producers like Venezuela and Mexico and Brazil and so on. What are the operating, could you have any sense of what the operating costs are, production costs in competitors' operations?
I actually don't, but I would nuance what you're saying. In terms of markets, I think it's absolutely to differentiate between crude quality. The Canadian barrels don't compete for space with American tight oil and U.S. refineries. The refineries in the U.S. are looking for heavy molecules that fit into their heavy processing units, which are distinctively different. For capital, competition for capital, they absolutely do compete. It's all about making revenue and returning profit to shareholders. And in that sense, they have to be competitive to be able to acquire the capital they need to be able to continue to grow and continue to operate. I think the big misconception is we get into is the difference between upfront development capital and operating capital or operating costs. So the big challenge for oil sands is that they have a higher upfront out-of-pocket investment required. So you have to lay out capital, $1 billion and more for 2 to 3 years before you get production to come online. And that's distinctively different from tight oil, where you can drill a few wells, get some cash flow, and use that cash flow to fund incremental drilling. And so you don't have the same amount of upfront out-of-pocket problem. The other side of it is, on the other side, is if you get over that hurdle rate in the oil sands, they are very competitive from an operating or cash cost basis. And because you don't need that upfront capital anymore. So you just need that sustaining capital to go in, and the cash cost to operate is what kind of those kinds of numbers. And they are in a zone where they are competitive. So your growth slows down in this environment, but you can produce production in a lower price environment. Nobody makes money in the prices we're seeing right now. But as prices come up, they can hold their own. The other unique distinguishing feature is the no decline aspect of oil sands. I'll say that they do decline, you just don't see it notably. And so what you will see is, we expect to happen is they're going to curtail output. They should be able to bring the majority of that back up. Whereas conventional, unconventional, we expect to continue to decline for a period here simply because of the natural decline rates associated with the production, which can be quite steep, 30% or more.
Let's talk about the competing for capital. My take on the last couple of years of operations in the oil sands, because you see them returning significant cash back to shareholders in the forms of dividends and share buybacks. And it seems to me that, like Suncor, for instance, grossed $20 billion in revenue in 2019 and returned $4.9 billion of it to shareholders. That's a very significant amount. And is that because there's an increased competition for capital in the oil and gas space globally? And so they have to make sure that they're always, returning a significant amount?
Yeah, I think a lot of the investment in Canada and is U.S. based, and that they have to compete with the shale producers and the experiences being that have occurred in the United States. And a lot of the investment that went in the United States failed to return significant returns to shareholders. So you can think of it as value as growth in some sense. And so the investors are asking for and wanting to see greater returns to them. And ultimately, oil, is a commodity that can generate wealth and revenue, but ultimately what the investors want is the money, not the oil, right? And so part of the metric has been, or pressure on companies to return more of that cash to shareholders. And in 2019, I think the big Canadian oil sands companies did quite a good job, and you noted it. Pre-dividend, I think the average free cash flow was 2.5 billion or something like that. In that kind of environment in 2019, they are capable of both funding growth, returning cash, and investing elsewhere into other diversification strategies as well.
Let's talk about something. This will be the last one on the production side, then we'll get into the GHGs. But I think it's important, and again, this comes from the Synovus investor presentation, and it jives with what you and I have talked about over the last 2-3 years, and that is the tightening of supply in the global heavy crude market. So Synovus had a graph where it showed, I think, significant decline, might have been 40%, maybe that's a bit high. But anyway, if you look at the US Gulf Coast, which was, Venezuela was a big supplier there, they've gone from 3.2 million barrels a day not that long ago down to 400,000 barrels a day. Plus you've got long-term decline in Mexican Mayan. And then also, I think I remember from an interview you said that Russia had taken 300,000 barrels of heavy out of production, or out of the market, because they were processing it internally. And all that's done, what that's done is really tightened the supply of heavy. And in fact, especially in the Gulf Coast, where the Keystone XL pipeline is going to send oil. And what does that mean for the short to medium term outlook for the oil sands producers? So
a couple things there, and you got a really good memory, because that was a long time ago we talked about Russia. If you look at the heavy oil market, you segment it out of the whole system, it's about 10 million barrels per day. So it's a pretty small share of the total. The United States is the largest market for heavy sour crude oil in the world, and the fastest growing market for it is Asia. Canada has been advantaged because we sit next to them, right? And you can talk about geopoliticals and trade, and there's downsides and risks of over dependence. That's fair. But the reality is they have a large, complex refining system that's kitted out for consuming heavy sour crude oil. It really began through joint ventures in the Gulf Coast with Latin American crude decades ago that was coming online that was heavier. And they signed joint sharing agreements to lock in that supply at certain prices to cover the capital of the build out of the heavy processing capacity required to handle it. So they built that for Latin American crudes. In the Midwest, it was to take advantage of growing Canadian supply. And heavy crude oil trades at a discount to take advantage of lower price feedstock and you pick up that margin on when you sell higher value refined product. And they made those investments. But now those Latin American crudes going to the Gulf Coast are falling off. In Venezuela, it's because of geopolitics and economic mismanagement and deterioration of capacity and assets and maintenance. Lots of really bad things happening in that country. And it's fallen off so fast. Up until a few years ago, Canada was keeping pace with those declines and keeping the system relatively balanced. But the pace at which Venezuela fell off, it showed up in the price. And we saw differentials, which are talked about pretty, every day in Western Canada. It's a way of life and the terminology. They tightened up. They're a combination of both transportation and quality, and that tightening of the heavy market narrowed the difference in quality between light and heavy crude oil. It was double-ended though, Markham. We had a slush of light crude coming on the market at a pace which we've never seen from the United States, long light, and we had a tightening of heavy, and these combined narrowed that difference between the two values of the crude. Those refiners will be reticent to descale. They have competitive advantage from it. It provides those refineries most flexibility in terms of the crudes they want to run to optimize crude slates. And it's made the United States Gulf Coast particularly one of the most competitive refining centers in the world.
Let's talk about greenhouse gas emissions out of the oil sands, Kevin. And this is important on a number of fronts. One is, investors like the Norges Bank, the Norwegian Sovereign Wealth Fund, are looking at both GHG intensity and absolute emissions as a criteria for their investment. So that's one. The other is climate policy, and the oil sands alone makes up 11% of Canada's national GHG emissions. So your 2018 study, which was very, very thorough, showed 127 kilograms of CO2 equivalent per barrel at the top end, 37 kilograms of CO2 equivalent per barrel at the bottom end, and the average was 77. Why the difference, the variability in the industry?
Well, there are different facilities, and they have different geologies associated. Like, I'm not a geoscientist, but if there's any on the call here, they'll throw a shoe at me. It's the rocks. But it is also operations. And we do find differences in the operations, and in the thermal operations. The amount of steam required to produce a barrel of oil varies by where they place the wells and the composition of what the subsurface looks like. And in the mining operations, it's how they're operated. But we do find the mines are generally fairly uniform, and the variance is fairly low with a few outliers. I'd say that's true in SAGD as well. Actually, interestingly, in that paper, if you look at it, we plotted the distribution of steam oil ratios by year. And you can see very clearly almost the reaction to prices. So the distribution collapsing and narrowing and normalizing over time. So the outliers are pulling in, they're coalescing around a steam oil ratio of about 2.7, which would be our average intensity, with the outliers pulling in. But you got to remember, when you look at average intensities, the outliers coming in reduces the average, right? Because you don't have as much of the higher carbon facilities emitting on the volume basis, so their weighted contribution falls. But yeah, so the variance is really operation by operation. There is a variance. And true, Markham, we put a paper out on a blog, must have been a month or so ago, where we looked at 3 basins where we did comprehensive analysis, everything in it. We found that same variation. So in the oil sands, we saw 3 times. We've seen plays with 9 times. We've seen plays with 5 times. And this kind of goes to my point. In that paper, I really didn't want to produce an average, because the average is misleading. It doesn't represent any one facility. And we need to get into conversations about individuals rather than averages, because it's kind of painting a broad brush across a sector that's 3 million barrels of production last year, and we think they could do 3.3. That's a lot of production to paint one number against.
Is it fair to say, Kevin, and I know this is a generalization, but bear with me here. Is it fair to say that the older facilities are generally the least efficient and the most GHG intensive? No, it's not the case.
We don't find that anywhere in the world you can make that claim. I'll give you a story. We modeled the entire. I actually can't share that, but no, we don't find that. In fact, in some places in the world, we find the original facility, the first facility, is the best. And there is some reason for this. To get over the hurdle required to go in and do a first-of-a-kind project, do something that no one has ever done before, the resource class that has to underpin it has to be so massive. The potential has to be so great to outweigh those risks. Operational risks, cost overrun risks. And so what we find is those facilities have really good resources. And so they tend, it's not always true that the oldest is the best, and it's not true the newest is the best. The newest certainly, if you took the same geology and put a new facility beside it that's 5 years newer, it will be better, because you can benefit the most from the latest technology, but you have to consider the subsurface potential that originated or was there too. So how good are the rocks, and what vintage you combine the two, but there's no uniform, newest is best necessarily. Compared to your peers, it would be, though. Like, if it's the same sort of geology, yeah.
Those interviews I did with Harbir China, one of the points he made was he liked a carbon tax because it forced Synovus to be more efficient, and it forced Synovus to look to choose its resources differently. So if it's looking at lowering its GHG intensities, then it's going to look at the amount of carbon that's in the bitumen in that particular resource and make different choices. And to what extent, I guess that backs up what you were saying about the resource that you pick to exploit.
Yeah, Canada's got a lot of policies for a major oil producer on its upstream, right? We've got a price in carbon. We've got a cap on emissions. Now, you know, the mechanism to enforce it's not there yet. And we also have methane restrictions that more for conventional, unconventional, which is a lot of policy for a major oil producer compared to its peer group. You know, the carbon taxes will allow companies to internalize the decisions, price out what the potential cost of supply could be from what they anticipate the greenhouse gas intensity will be. But I think to some degree as well, the financial community is pushing that onto the oil and gas companies as a whole now too, by asking for greater disclosure to understand the intensity and the future intensity, asking for targets from them, and transition planning, those sorts of things. That's also forcing internalization in terms of being able to respond to shareholder inquiries about how they intend to decarbonize or respond to be more competitive in a carbon constrained world.
Do you have a sense of how the oil sands producers' GHG intensity compares to other heavy crude producers? And I know we've had this conversation about problems with data, right? In a lot of the countries, data is poor or not available, or it's estimated from sources that are not very reliable. But do you have in general a sense of how we compete against Venezuela or Mexico and other countries?
This stuff has changed. As Venezuela deteriorates, I think it's safe to say their intensity is getting worse, like rapidly. So the numbers I have are at a period of time that they were better, probably. But I would say on, you know, the Canadian oil sands looked to be similar and not distinguishably different. But I really would caveat that data is old, and I would, you know, I also don't know if I agree with framing them against other heavy oils in terms of intensity alone. I think you have to look at different metrics all at the same time. Upstream intensity to your peer group, which is more than heavy oil in terms of investment. Full life cycle intensity, because there are ways to decarbonize downstream. Mine PFT, for example. If you increase the severity of which you're precipitating out of some of the heavy molecules in the mine, or in the separation process, you can decarbonize some of the downstream refining. But in our studies, we found the oil sands isn't to be within the range of other crudes consumed globally. I think in that study in 18, we had -1 to 16% above our estimated US average. The study from Stanford, that's highly cited, you know, does have oil sands in the upper quintile. But, you know, if you consider the upper quintile is about 25 million barrels globally, oil sands is 3 million. So 15% of the 25%, it's not, you know, it's not distinguishably different even in that study. It's, you know, it's above average, but it's within the range of other crudes consumed. I think another thing to consider is what is the trajectory of emissions is important too. The metrics to perform are different, or they're changing rapidly. You know, 10 years ago, it was really about finding oil and producing oil. And then it became about returning cash, but now it's returning cash and decarbonizing at the same time. And behavior will change and the companies will adapt. The oil and gas sector is incredibly dynamic. I think a good example is, you know, we saw this COVID-19 price collapse. You know, demand fell 20 million barrels per day in a month. This is the single largest shock the oil sector has seen in its entire history. And how did the sector respond? They've shut in North America, like I think it's 2.8 million barrels in a matter of weeks. This has never happened either. They pivoted on a dime, and we're seeing refinery runs come back. We're seeing some inventory draws. Now, a couple data points does not make a trend, but we are seeing, you know, these stay-at-home edicts ease. We're seeing some improvement in economic activity. It's going to be a long haul out, but this has happened all within, you know, a matter of weeks.
Well, Kevin, I thank you very much for this. I think we're going to open it up to questions now. So in your manage participants little box that you've got on your screen, you should be able to click on that and raise a blue hand if you want to ask a question. And then I'll call on you to unmute your mic and ask your question of Kevin, if you would, please. So Dave Patterson, you're up first. If you would unmute your mic and ask your question, please.
Hi. So do you see a differential between in the oil sands between companies like Syncrude that are, you know, heavily refining the bitumen into, you know, their sweet blend, which is, you know, equivalent to what, WTI or better, and just the guys that are producing bitumen. So what is the differential in price and greenhouse gas emissions between those two camps?
Well, SCO would tend to get WTI plus $1 or so. If you're in Cushing, right? So you take the transport out, but we get into the fact that SCO doesn't really get cleared in Cushing. It gets cleared in Chicago, and we're going to get into a bunch of balls and wax differences. Whereas heavy sour crude oil to WT, so let me think about this in terms of differential. So SCO in Edmonton would get, you know.
I was thinking more of their costs to produce.
Oh, okay.
And versus, you know, their greenhouse gas emissions to produce.
This is interesting. So when you take all the cash cost in, SAGD and mined SC are quite similar when you adjust for the quality.
You mean in terms of GHG intensity?
Cost. Cash
Oh.
cost. Yeah. Because they get the higher price, right? So it offsets some of the higher costs. Whereas in the SAGD, they're a little bit lower cost, but they get a reduction from WTI, right? And it's kind of, right now we have them pretty close together in terms of their cost structure, around $20, $25. Some are lower, definitely on the mining side, because the advantage of having to be able to sell something at slightly higher value. In terms of emissions, typically mines with upgraders are going to be higher or more intensive than SAGD, but there is overlap between the two. And I think that's clear in the 2018 study. And it is going to vary by facility quite a bit. I think in the 2018 study, we had a thermal operation being the lowest greenhouse gas and a mine being the highest. We're just doing an update. In this one, we're going to have a mine probably be the lowest and a thermal operation be the highest. And so there is a little bit of overlap there. But yeah, if you have an upgrader, you're picking up the emissions of downstream processing in the upstream facility. And so that if you're just looking upstream, which our study did, it'll push up the intensity on that basis.
Kevin, I had a question from Dr. Debbie Gordon actually the other day about petcoke, which is a byproduct of the upgrading process. Is that or is that not included in the emissions?
For our study, it is not because we're not doing the downstream piece. We're focused on the upstream. Any emissions of combustion of petcoke on site is included in our study. Any that is not included in our study. A lot of the petcoke produced in the oil sands is surplus and stacked and stored. It's not combusted. The downstream refineries would be making their own choices what to do with the petcoke that comes off their facilities in the Gulf Coast and elsewhere. And petcoke, for the most part, would go in and compete against coal into coal facilities or maybe some steel smelting, depending on the quality of it. In life cycle analysis, petcoke is one of those areas where there's differences of opinions. Some people think that petcoke should be included in the crude cycle to accentuate the differences. My tendency is to think of it as a product that belongs in the power sector because that's ultimately where it's combusted. And if we remove it, we're basically saying those petcoke molecules going into power would be carbon-free because they're accounted for in oil, where you double count them. But it's definitely a difference. There are definitely differences of opinions. And there's other ones too, Markham, in life cycle, like treatment of co-products that come off refineries and petrochemical feedstocks. How do you treat them? Do you treat them as a crude oil, or do you consider them sequestered in polymers and plastics? And in doing so, if you do that, it would incentivize companies to decarbonize their pathways by investing in greater petrochemical integration, which maybe we want as a society, but there's differences in approach there too.
Okay, Rosalind Warner, if you're up next, if you can ask your question of Kevin, please.
Hi, thanks. I'm wondering if you can expand a little bit on the effect of the price differential between the United States and the Asian markets, and how important is that in the viability for the oil sands in the long term?
You mean the spread between like Singapore and Gulf Coast TI?
Yeah, whatever you think might have the biggest impact.
Asian pricing is not an area I spend a lot of time in. I got some great colleagues in Singapore and Beijing that do that for us. But I would say for our base assumption for Canadian crude is we continue to believe it will clear in the Gulf Coast, or the Gulf Coast will be the price setting mechanism for Canadian heavy sour crude oil. And so with that, you'll incur the transportation cost to that plus the quality differential between that. And I think our base range is somewhere between, maybe 13 on the lowest and $15 to $16 on the highest, and it should sit in between there. There's going to be volatility around that. It's never going to be quite right, but it'll always kind of bounce around that area. For the lighter crudes, we continue to think they will clear in the Chicago area, SCO and MSW, and with that, a narrower differential. SCO close to parity, and MSW maybe a couple of dollars on the WTI.
Kevin, I've got a question for you about Asia, because I interviewed your colleague, RJ Chang, last year about refineries and petrochemical complexes in China and in Asia generally, I guess, that use heavy crude oil as a feedstock. And so they're refining and they're making petrochemicals. What's your take on that? Is that going to be significant demand for Canada, or is that not?
I don't know if I can comment too much. I'm not that person in our company. Refineries are partly magic for me still, that let me get in my car and move it around. I'm more of an upstream person. We do see a lot of interest in greater petrochemical integration, at least before COVID hit us, because it makes sense because you can get better heat integration, more efficiencies, economy of scale, you can lock in on feedstock, all those things. But it's not an area of expertise for me, I'm sorry.
Yeah, fair enough. Dave, you're up next. If you can unmute and ask your question, please.
Just a question. If you were in Jason Kenney's office right now and advising him, what would you be saying to him about the future of Alberta oil and the things he can do to make that be as environmentally sound as possible and as economically advantageous for Alberta as possible?
Easy question, eh? Sounds like I should read a paper. I think I'd have to make a distinction between the immediate issues and the long-term issues. The immediate issues is there is a significant shock the industry is still dealing with, and I think the industry is still moving through it. I think that is about liquidity for smaller producers, access to capital, and maintenance of the service sector capability that will be needed on the other side to basically for the conventional unconventional stroke guys to recover the volumes that are lost. On the oil sands side, they're going to hurt too. They're going to delay further spending. Future growth will probably be slowed as well. I think there is a bigger, broader question about the ability to grow production and lower the intent and continue to drive emission intensity. And I think that's not necessarily driven by government policy anymore. I think it's being driven by institutional investors and financial institutions as a whole who want to see that. And that's hard to execute in this environment. And I think over the longer term, they're going to have to do that. And I think they are. Our study in 2018 showed that they're decarbonizing. Now, a point of debate we can get into is whether it's fast enough, and what role the government can get into to help accelerate that. You can take the view that we collect our royalties and our taxes, and the money should be used to build wind turbines and whatnot. That's one view. The other view is, does the government have a role in its process of collecting royalties and taxes to invest some of that back to incentivize different behaviors or accelerate behaviors? That's what led to the oil sands in the first place. Syncrude and Suncor were benefited from government support, even Hibernia government support to get the industry going, both on the East Coast and in the oil sands. Sorry, I can't comment on specific policy advice. It's a place my company won't go. Everybody's a client, so Jason Kenney included, all the producers, and many other governments as well.
Fair enough, Kevin. And one of the things that I think is not well appreciated in Alberta, I know I write a lot about it, but the fact of what's coming from the federal government on climate policies, clean fuel standard. They've got a number of policies that are designed to lower emissions in oil and gas production. And where do you have a sense of the impact that might have on the industry over the next 1, 2, 3, maybe 5 years?
On CFS specifically, I haven't done any detailed analysis, so I can't speak to it. I think, you know, you should, I think there is a number of policies coming. I think the biggest question is, how does Canada's policy framework compare to its peer group? You know, there is a risk that you can push to a certain extent, but there is a risk if you take too much capital or too much revenue out of it, that the capital simply flows somewhere else. And, you know, in GHG, it's carbon leakage. And so your net benefit to the world is negligible because you're just shifting emissions around to other jurisdictions. I think the other thing that can be thought of is, can the industry's efforts be exportable? You know, they are investing, there's the Carbon X Prize. Those are exportable solutions. You know, they come up with better ways or more efficient ways to boil water. You know, that's a big part of a thermal plant. It's a water treatment facility. A lot of boiling goes on. If they can improve the efficiency, there's a lot of places in the world that use those same boilers. And so I think a lot of the solutions are exportable. I think the problem with, you know, when we talk about emissions, people confuse the product with the emission. And can we decouple that thinking and go after the emissions rightfully, and make the use of the product more acceptable? Because right now, you know, we have a lot of people talking about what's going on in COVID and the impact of oil demand long term. Whatever's happening now is not going to be predictive of oil demand long term, nor is what was going on in 2019 going to be an equal predictor of what it'll look like in 2022. Things are going to change, but how they change, we don't know. But what we do know right now is most of the infrastructure that exists today that will be turned back on involves a combustion engine of some sort. And so how do we decarbonize the pathway, or invest in decarbonize that pathway? Because that infrastructure is not turning over overnight. You know, I always give we've talked about this before, Markham, the average life of a car on the road is 13, 14 years. That's your fleet stock turnover for 99% or 98% of the world's fleet. You're looking at 10 years. That's why when you look at decarbonization in the automotives, CAFE really matters, because it inflects the, you know, I'm talking about the fleet, but if you talk about sales, it's still 97% combustion engine. Change 98% of combustion engines is more material than moving from 97 to 96% of EVs. And EVs will sell more and more, and we'll buy more and more of them. But can we move both dials at the same time?
I want to address an issue that got raised first in the federal government's Generation Energy's Futures Report, came out in 2018. And there's a section in there, one of the pathways to lower emissions is clean up the oil and gas industry, you know, lower emissions there. And there's a little brief mention of small modular nuclear reactors to electrify processes in the oil sands. What's your take on that?
Can I just say I'm not a physicist? You know, I think the idea is move some of the combustion away, right? Like the idea is to remove the combustion component of thermal generation, or the steam requirement, to something that's renewable. I think there are a number of efforts. One of them, you know, proposes nuclear, but there's a number of other ones that are proposed. You know, oxy-fuel combustion. You know, you're changing or getting one singular point source you can more readily capture, because you get a much cleaner stream of CO2 you can capture and sequester. There's lots of opportunities. The challenge is there's risk associated with these opportunities, because a lot of them have never been done. Costs money, and there's no money right now. And so are we delaying some of our decarbonization through this period as well, and impairing some of that as well? I don't think that's unique to Canada in any sense. I think oil and gas generally is facing these challenges of decarbonization and investing capital decarbonization. And that's kind of getting zapped at the moment.
Jordan from Mount Royal, you're up next. If you can unmute your mic and ask your question, please.
Hi, thank you. If the internalization of environmental costs and the pressure for decarbonization is primarily being driven by the financial industry, as you said, what's the risk that we see, like with the government regulation pushing us out of the market or getting too ahead of competitors? What's the risk of basically the financial industry doing the same thing by pushing for those same levels of decarbonization as you can see with a high carbon tax?
I don't know if I have a complete answer, but I think you're seeing some of it through divestment, right? Like that's basically what it is. I always say divestment isn't decarbonization, which is the challenge. You know, but I think you are seeing some of that already show up. I think part of it is limited by the comprehensiveness of the data available, you know, to set thresholds and metrics that allow improvement. and enable people to gradually change over time, as opposed to just, this is good and this is bad. But I can't give you a complete answer. I'm sorry.
Well, what about let's talk briefly, and we'll wind this up fairly quickly, but the influence of the financial community and investors, global investors, we're seeing it more and more. And we saw it with BlackRock's now infamous letter in mid-January from Larry Fink. We've seen it with Norge's decision. And the oil sand, Alex Pourbaix, the CEO of Synovus, wasn't pleased with Norge's decision to blacklist Synovus. Is it likely that we'll see more of that kind of more assertive behavior on the part of the financial community going forward?
I wouldn't rule it out. I can't speak for them, but I think part of it is they're under tremendous pressure to demonstrate that they are making decisions that their portfolio is consistent with transition and trying to get their arms around that. And that's what's driving some of these decisions. I think you're seeing frustration from some of the oil companies and the oil sands companies specifically, because they're being labeled and we're using averages. And Pourbaix's got an asset that's amongst some of the best in the oil sands. And they'd be near or close to the U.S. average in our estimate as well. And so, this broad brush, I think, is what they're struggling with. And in particular, the timing, in this environment was probably not, didn't probably get your best response from anybody at this point. But I think it's frustration. Can we have a more detailed conversation? Can we have a conversation about trends in decarbonization? And can we get a better picture of what the whole world looks like and how the oil sands fits into that, or how different oil sands assets fit into that? But I don't, for where I sit, I'm an analyst. I try to run numbers and I try to make sense of the world, but it's hard for me. I try to keep my opinions out of the whole thing, Markham, about how I feel. But it's, I think this is a question of more research. I think we understand very well what the oil sands look like. I'm not sure we have the equivalent understanding of everything around the world.
Fair enough. Kevin, thank you very much for this. We've packed a lot of information into 45 or 50 minutes. Really appreciate you taking the time out of your busy day. And I look forward to interviewing you more in the future. Every time I do, I learn a lot.
Thank you.